All right, let's get right into it. The latest inflation numbers just dropped, and at first glance, they seem like pretty good news. But today, we're going to dive deep into an analysis from Wolf Street that makes a pretty bold claim that the official Consumer Price Index report, well, it might be hiding something important. And that's really the big question we're tackling here, isn't it? When the government puts out a number that impacts everything, from our savings to the stock market, we expect it to be rock solid. But what happens if it's not? Let's dig in together and see what the data really says. So to really understand what's happening, we've got to look at this as a story with two sides. First, there's the official story, the one you probably saw in all the headlines. And then there's the other side, the strange cracks that start to show up when you look just a little bit closer. I mean, wow. The author of the Wolf Street analysis, Wolf Richter, he does not pull any punches. He calls the report doctored and a bad joke. That is some incredibly strong language. So what could possibly be going on to make someone say something like that? You know, the headline numbers all pointed towards inflation cooling off, which is what everyone wants to hear. But according to Richter, the moment you actually click open the full report from the Bureau of Labor Statistics, the whole picture gets a lot weirder. And this is where our investigation really kicks off. It's a bit of a mystery, but one that centers not on what's in the report, but on what's clearly missing from it. And here we go. This is a stripped-down version of the summary table right out of the official report from the Bureau of Labor Statistics, or BLS. Now just look at the columns for October and November. See all those dashes? They're almost completely blank. The only real data in there is for stuff like energy, which the BLS gets from other places. For almost everything else, nothing. This brings us to a super simple, totally logical question. Inflation is the change in prices from one month to the next, right? So if you don't have the price data for October, how on earth can you calculate the change for November? It's the most basic piece of the puzzle. Well, here's the official explanation, and this is quoted right in the BLS report. A lapse in appropriations, which is just government speak for a shutdown, meant they couldn't collect the data in October, and they couldn't go back and get it later. So what on earth did they do instead? So according to the agency's own notes, they had a procedure for this. Since they had zero new data for October, they just took the numbers from September and basically copied and pasted them. Then they calculated November's inflation by comparing it to that old copied data. And that is the move that's at the center of all this scrutiny. Now, this whole copy-paste method might seem like a practical, if clumsy, workaround, but it becomes a gigantic problem when you zoom in on one specific, and I mean hugely important, part of the entire inflation calculation. It's this thing called owner's equivalent of rent, or OER. Yeah, it's a bit of a weird concept, but it's supposed to measure what housing costs are for people who own their homes. But here's the absolute crucial point you need to remember. It is the single biggest piece of the whole inflation pie. And just look at how massive its influence is. According to Wolf Street's breakdown, OER makes up over a quarter of the main CPI number. That means any little error, any strange fluke in this one single component can completely warp the final result for everybody. And right here, this chart is basically Wolf Richter's entire argument in one picture. The September OER number, you know, the one they copied and used for October, was already a suspicious outlier. It showed this massive, sudden plunge in housing inflation. And because that unusually low number got carried forward, we've now had 3 straight months where this key metric has been stuck at what looks like an unnaturally low level. So, okay, this is a fascinating statistical debate, but why does it actually matter to you? Well, this isn't just an abstract argument. It has very real, very tangible effects on people's money and on the economy as a whole. According to the Wolf Street analysis, if inflation is being underreported, it means that anyone whose payments are linked to that official number could be getting shortchanged. We're talking about investors in certain government bonds, seniors who depend on Social Security cost of living adjustments, and literally anyone with a contract that has an inflation clause. And the effect here is really twofold. On one hand, yes, people and investors might get smaller inflation payouts. But on the other hand, it can actually make economic growth look better than it really is. That's because when the government calculates real GDP, it subtracts inflation. So if you use a lower inflation number, poof, the real growth number magically looks higher. And all of this leads us to a much bigger, more fundamental problem. This isn't just about one flawed report or one weird number. It's really about the trust that we all place in the official data that shapes our entire financial world. This quote, which was highlighted in the source material, just nails how high the stakes are. The entire financial system is built on a foundation of trust in this data. If huge players, like the bond market, even start to question if the numbers are legit, it could cause all sorts of unpredictable chaos. And that's really the question we're left with, isn't it? The analysis from Wolf Street lays out a pretty compelling case that the latest inflation report is, at best, deeply flawed because of that missing data, and at worst, seriously misleading. It's a critical reminder that it's always worth looking past the headlines and asking, what's really going on inside the numbers?